Subscribe to my channel Report Stock.
Welcome to the deep dive. You know how sometimes you look at a dense financial report full of numbers and jargon and you just wish someone would cut through it all and tell you what really matters?
Yeah, absolutely.
Well, that's exactly our mission today. We're plunging into the latest Q2 2025 financial results from Texas Community Bank Shares, Inc.
That's the holding company for Broad Street Bank, SSB.
Exactly. And trust me, beneath all those figures, there's a truly fascinating story here, a remarkable turnaround.
It really is. We're talking about a significant shift, and it's worth digging into how they managed it.
So our goal here is to give you not just the facts, but the crucial insights.
Right. Insights into how a regional bank like Broad Street Bank navigates, complex market dynamics and how it leverages smart internal strategies to achieve financial success.
It's never just about the raw numbers.
No, it's about understanding the why behind them, giving you a solid grasp of a company's health, its strategic direction, and, well, what that means for its future.
Okay, so let's start with the numbers that really jump off the page, the headline figures.
The ones that show the shift.
Yeah, the dramatic shift from red to black. For Q2 2025, Texas Community Bank Shares reported a net income of $678,000.
Which is a solid jump from the $348,000 they posted in Q2 of 2024.
But here's the really dramatic part. For the first half of 2025, they actually posted a net income of $1.3 million.
Okay. And compared to last year.
Well, compare that to the same period in 2024, they had a net loss of $2.3 million.
Wow, that is a monumental swing, a huge turnaround.
Huge. And get this, Q2 2025 marks their best quarter since their IPO 4 years ago.
And the fifth straight quarter of increased earnings, right?
That's right, fifth straight quarter. So you have to ask, what was the secret sauce here? How did they pull off such a complete reversal?
It's a powerful narrative, isn't it? And what's particularly interesting is how the CEO, Jason Sobel, explains it.
What did he say?
Well, he said he was thrilled about the trend, which you'd expect, but he directly attributed it to two critical strategic shifts. First, the balance sheet repositioning they completed last year. And second, a relentless focus on efficiency improvements.
Ah, efficiency. Always key.
Definitely.
Yeah.
He elaborated that the main drivers were prioritizing higher-yielding commercial loans and relationships, a continuous effort to fine-tune their loan and deposit pricing.
Right, to expand that net interest margin.
Exactly. That difference between what they earn on loans and pay on deposits. And also just exceptionally close management of all their expenses. It's a very clear roadmap they followed.
And this financial transformation, it's not happening in a vacuum, right? You need to understand their footprint.
Yeah. Their local presence. Broad Street Bank's home office is in Mineola, Texas. They've got branches across Wood, Smith, and Van Zandt counties.
They expanded recently too, didn't they?
They did. Q1 2024, they opened a new branch in Tyler and a new building for their Lindale branch. That brought them up to 7 full-service locations.
So with this improved financial strength, how are they planning to, grow on the ground, expand their reach?
Well, the company clearly feels, and I quote, stronger and better positioned to capitalize on opportunities in 2025.
Makes sense.
Their daily focus is explicitly on enhancing market share, expanding their physical branch network, and growing their client base.
So it's not just numbers. It's about deepening community ties.
Precisely. Leveraging that improved health to increase their presence. They seem fully committed to executing their strategic growth plan. The ultimate goal, of course, is creating long-term value for shareholders by expanding both their physical and client footprint.
Okay, so we've seen the big picture, that impressive turnaround. Now, let's maybe peel back the layers a bit. Understand the specific financial levers they pulled.
Let's do it. How they manage income and expenses to make that shift happen.
Right. Where do we start?
Let's start with net interest income. That's really the heart of a bank's profitability.
Right.
It's a healthy increase, nearly 6%, reaching $6.5 million for the first 6 months of 2025.
And the crucial insight here.
It wasn't primarily from earning more interest on assets. It was largely from paying less interest on liabilities.
Really? How so?
This was mainly due to a massive strategic reduction, nearly a third in their Federal Home Loan Bank advances, FHLB advances.
Okay, explain those quickly.
Think of them as, well, relatively expensive wholesale funding they borrow. They slashed their FHLB borrowings by $22.0 million.
$22 million? That's significant.
It is. And that single move significantly cut their interest expenses, added hundreds of thousands directly to their bottom line for the half year. It's a huge win for managing their funding costs.
Wow. So that one move basically accounts for a big chunk of the income improvement right there. That's a powerful lever.
It truly is. And on the deposit side, things were also interesting, even though their overall deposit balances grew.
By almost 5%, right, to nearly $340 million.
Yeah, even with that growth, their deposit interest expense stayed relatively flat.
How do they manage that lower rates?
Pretty much. Thanks to a disciplined approach to deposit pricing, they actually decreased some rates they paid out, which, suggests a pretty strong, maybe sticky, local deposit base. That directly boosts profitability.
Makes sense. Did they bring in other types of deposits?
They did strategically add $10 million in broker deposits at the end of 2024, probably to manage liquidity or perhaps fund specific loan growth.
Okay. And what about total interest income? Did that grow?
It was generally flat for the first 6 months, but it did dip slightly in Q2 2025 compared to Q2 2024.
Why was that?
That was primarily due to reversing some accrued interest. Remember those two large loan relationships that were placed on non-accrual status?
Ah, right. Meaning the bank stopped recognizing income from them because payments were late or collection was iffy.
Exactly. We'll touch on those specific loans again in a bit.
Okay, so we've seen how they fine-tuned that core banking engine managing interest income and expense. But what about the other stuff? Non-interest income, operational costs?
Good question. Let's look at non-interest income first. We saw a significant boost there of nearly 50% in Q2 2025 compared to last year.
50%? What drove that?
Primarily, it was a gain on an equity investment they held. And importantly, the absence of certain losses they had booked in 2024.
Like what kind of losses?
Things like losses from selling some loans or from other real estate they owned. Getting rid of those negatives helped a lot.
Okay. Any offsets?
There was a slight decrease in other service charges and fee income, but yeah, overall non-interest income was a strong positive contributor.
And on the flip side, the non-interest expenses, where did they save money or maybe spend more strategically?
Right, this is where you see that balance. Aggressive cost management mixed with strategic investment. Overall, non-interest expenses actually decreased
It went down. By how much?
by nearly 4% for the 6 months, mostly due to big reductions in tech expenses and salary and employee benefits.
Technology expenses dropped.
Well, they dropped by almost 60%, but it was largely because they had some one-time fees in the first half of 2024. For that tap debit card project implementation, those didn't repeat.
Ah, okay. One-off costs. And salaries and benefits.
Also down. Things like reduced officer compensation, lower costs from equity awards. There was even a one-time reversal for some forfeited awards.
And didn't you mention something about the board?
Yes, that is a specific example of efficiency. They actually reduced their board size from 14 directors down to 12 last year and then down to 9 this past May.
9 directors now.
Yep, and that alone will cut director fees by about $18,000 each quarter going forward.
So they literally trimmed the fat, even at the board level. It really shows commitment to efficiency.
It does. A deep commitment. However, it wasn't all cuts. They strategically increased spending in some key areas.
Like what?
Well, other expenses, for instance, actually rose by over 20%.
Okay, why they increased there?
It was due to a few things. Higher audit and accounting expenses. They're doing more internal audits, plus some price adjustments. And, interestingly, a notable increase in marketing expense.
Marketing. What are they doing there?
They brought on an outside consultant, launched a new ad campaign, including local TV and streaming services.
So they're investing in growth, too.
Exactly. It shows they're not just cutting indiscriminately. They're making thoughtful investments in risk management and future growth.
This incredible turnaround, it does raise a crucial question, though. What about the actual health of their loans? The asset quality. How strong is the bank's foundation after all these changes?
That's an excellent point. Asset quality is absolutely paramount for any bank. The company recorded provision for credit losses of $71,000 for the first half of 2025.
Okay, is that high or low?
Well, it's an increase compared to the same period in 2024. Back then, they actually had a reversal of provision, meaning they reduced their reserves.
So why the increase now? More risky loans?
Not necessarily risky, but it's primarily a natural result of their loan portfolio growing about $21 million on average, and also some changes in the mix of loans they hold.
Okay. But is the overall quality still good?
The report emphasizes that, yes, despite the higher provision, net charge-offs, that's loans they've actually written off as uncollectible, remain very low. And the overall quality of the loan portfolio is considered strong.
That's reassuring. But you mentioned those 2 large loans on non-accrual status earlier, the ones impacting interest income. What's the story there? Are they a major concern?
Right. It's important to look at the challenges, too. Despite the overall strength, they did see an uptick in past due loans and non-accrual loans at the end of June.
And that's directly related to those two loans.
Yes, directly related. Those two relationships total $9.0 million.
Can you give us specifics?
Sure. One is a $6.2 million construction loan. It's secured by a newly built multifamily property. Construction's complete. It's fully funded.
Okay. And the other?
The second is a $2.8 million loan secured by land that was bought for development.
Are they well secured at least?
They emphasize that, yes, both are well secured by the real estate, with loan-to-values under 65%.
So a decent equity cushion.
Correct. And the clients are apparently actively working to resolve the issues. But, this does highlight how banks have to manage risk, even on assets that seem well collateralized on paper.
Yeah, collateral's great, but cash flow pays the bills.
Exactly. Cash flow issues or project delays can still impact a borrower's ability to pay. Constant vigilance is needed. They also mentioned having 2 bank properties listed for sale, valued around $428,000, classified as other real estate owned, or OREO.
Okay, that gives us a clearer picture on asset quality and those specific challenges. Now, what about their overall capital strength, the bank's buffer, essentially, and how are they investing that for the long term?
Their shareholders' equity, the bank's book value, a key strength indicator, showed solid growth. It increased by over $760,000 in the first half of the year, reaching nearly $53 million by June 30th.
What drove that increase? Mainly the profit.
Mainly the $1.3 million net income, yes. Plus some positive accounting adjustments related to comprehensive income and contributions from employee stock plans, like the ESOP and equity plan vesting.
Were they returning capital to shareholders too?
They were. They actively repurchased over $1.3 million of their own common stock, and they paid out quarterly dividends totaling $242,000. So active capital management.
But overall, equity still grew.
Yes, the net effect was positive growth in equity. And importantly, from a regulatory standpoint, Broad Street Bank was reported as well capitalized at June 30th.
What does that mean in numbers?
They had a leverage ratio of over 11.3%, which is very healthy. It means they have a strong capital cushion relative to their assets, vital for regulatory health and, weathering any potential economic bumps.
That's definitely reassuring. Now, earlier, the CEO mentioned investing more than ever in new tech and products. We saw the expense increase for marketing and maybe some tech overlap. What specifically are they rolling out for customers?
Yeah, they seem to be really doubling down on digital transformation and customer convenience.
Like what?
They have invested in and implemented an automated consumer loan process, supposedly seamless, from application right through to funding.
Okay, that's useful.
They've also rolled out online account opening and online mortgage products, making basic banking more accessible anytime.
Any hardware changes?
They're setting up deposit-taking ATMs, so more convenience there. And on the product side, developing new treasury management tools for business clients, and even things like one-time close home improvement loans.
Sounds like quite a bit.
It all ties back to what the CEO said about finding the needs of our clients and filling them. It shows a clear strategy to evolve their offerings and stay competitive.
Okay, so let's try to summarize our deep dive here on Texas Community Bank shares. They've truly executed a remarkable financial turnaround.
Absolutely remarkable.
And it wasn't just luck. It was driven by disciplined expense management, like that big cut in expensive FHLB advances and really smart management of deposit rates.
Right, controlling the core costs.
But crucially, they're also making strategic investments in technology, in marketing, aimed at future growth, all while, carefully navigating those specific, albeit well-collateralized, loan challenges.
Exactly. I think this report offers a fantastic window into how focused financial management, combined with a clear commitment to customer-centric innovation, can drive really significant performance improvements, even for a regional bank in a competitive market.
Yeah, it really highlights the importance of looking beyond just the bottom line number.
You have to understand the underlying strategic decisions that create that long-term value.
And as you, our listener, reflect on this compelling turnaround story, maybe consider this. Given the details we heard about Broad Street Bank's tech investments, especially in automation and online services, how might traditional branch networks evolve for community banks like them?
That's a good question.
And what does this ongoing digital transformation ultimately mean for the future of your own in-person banking experiences? Something to think about.
Definitely food for thought.
We encourage you to consider those implications and continue your own learning journey. Thanks for joining us on this deep dive.
Subscribe to my channel Report Stock.